Hello everyone, thank you for watching this video. In this video, I would like to share about free cash flow. Disclaimer, whatever case study I present here is for your own education. There's no buy or sell call. Free cash flow. So free cash flow is the amount of excess cash the company can generate after maintaining their building, plant, buying equipment, and or whatever investment they need to make to keep their business going. It is given by this equation. This is the conventional way. Free cash flow equals operating cash flow minus capital expenditure. Also, if the as a rule of thumb, investor you have to see this number for free cash flow to be positive. Better still, if you want to see this number is going up, because rising free cash flow, it means the company is thriving in their business environment. If the company generate negative free cash flow, it could mean two things. Number one, the company is making large capital expenditure. The capital expenditure is so large that it is bigger than the operating cash flow. That's why you have negative free cash flow. Or secondly, in the first place you have a negative operating cash flow. So this usually happen in a young company because they need to gain market share, or they're doing that's why they're doing cash burn. So in this scenario, you want to make sure the company has large amount of cash on the balance sheet so that they can continue to do cash burn. But we want to see this cash burn number to be as small as time goes by, because all in all, we want to see this number going up over time. So if the company is doing cash burn, you just need to divide the amount of cash on the balance sheet by the negative free cash flow. That will tell you how many months or how many years the company can survive if they keep doing cash burn now. Okay, next I want to show you what a company can do if they have positive free cash flow. The company can do, in general, company can do three things. Number one, they can pay down their debt, which is good because this will reduce this will improve the company financial strength, will reduce their risk. Number two, they can make investment. They can acquire companies, so that they can grow inorganically. Or thirdly, the company can take the positive free cash flow or the excess cash to pay us as a dividend as well, or they can buy back their shares. But if the company pay dividends, you got to make sure the company has have a free cash flow which is larger than the dividend per share. So that will mean a sustainable dividend payment. So how to analyze for the free cash flow? Number one, you need to check whether this number is positive. Number two, you want to look at the historical trend. So if you divide the free cash flow by outstanding shares, that will tell you the free cash flow per share. So in this table, I will show you how the company free cash flow per share go up or go down. So let's say you have a free cash flow going up as compared to last year, but you have a stagnant outstanding share, then that will mean free cash flow per share going up. So on the other hand, let's say your free cash flow being stagnant, but your outstanding share is going up, because the company is doing right issues, or company employees doing their share because of stock-based compensation, then you will have this free cash flow per share going down. Or number three, let's say your free cash flow per share or outstanding share is stagnant, then your free cash flow per share will be stagnant. Or number four, let's say your free cash flow per share is rising, and the outstanding share is also rising, but the difference here is that the free cash flow is rising at a much faster rate, then your free cash flow per share will go up. So, but on the other hand, let's say your outstanding shares are going up at a much faster rate, then your free cash flow per share will go down. So, as a rule of thumb, as an investor, you want to see this number of free cash flow per share going up, because that will mean the company is able to generate excess cash on per share basis. Or if let's say the free cash flow per share is going up, the company can do a lot of things. Or they can pay more dividend per share. So let's look at our case study here, Sheng Siong. So the free cash flow per share is given in by this green line. So number one, you want to check whether this number is positive. Yes, as you can see here, in the latest years, this free cash flow per share is positive, which is good. Which is something you want to see. Number two, you want to look at the historical trend. So you can see here, the free cash flow per share is going up over a long term, which is good. Because Sheng Siong pays dividend, you want to check whether this dividend payment is sustainable. Because ultimately, dividend is paid out of free cash flow. So as you can see here, since 2017, the free cash flow per share given in the green bar here is more than the dividend per share in the orange bar, which is good. It tells you that the dividend payment is sustainable. However, in the early years from the year 2011 to year 2016, the free cash flow per share is less than the dividend per share. So in the early years, I can say the dividend payment is not sustainable. But I got to check whether the company has some extra cash on the balance sheet to pay you dividend, or the company whether the company is borrowing money to pay you dividends. But after the year 2017, it becomes okay. Next, if you divide the free cash flow by the sales revenue, then that will give you free cash flow margin. So I really like to calculate this number because it tells you whether this company is a cash machine or cash cow. If the company can generate double-digit percentage free cash flow margin, then this company probably is a cash machine. Because if the company can generate a lot of excess cash on the given unit of sales revenue, the company can do a lot of things. They can pay you dividend, or they can acquire other companies. They can grow the company even further. So strong free cash flow margin is a sign that the company has an economy mode. This is something we want to see for our long-term investment. Okay, let's study Sheng Siong. So if you look at Sheng Siong, in the latest year here, you have a double-digit percentage free cash flow margin, which is good. But as compared in the early years, the company has a single digit. But all in all, this number is going up, which is good. This shows that the company is actually in some way is widening their moat. Is gaining some competitive advantage. That's why they can able to generate double-digit percentage free cash flow margin. So next, you know that the free cash flow is given by this equation, the operating cash flow minus capex. So let's look examine further this capex. How do you know whether this company is capital intensive? You can calculate the capex margin. Capital expenditure divided by sales. If the company capex margin is more than 10%, I would say the company is capital intensive. I prefer to see my investment to be capital light because capital intensive, they can have the company have to spend a lot of money to maintain the equipment, and it's very hard to scale a lot faster. So, but if the company has a double-digit percentage capex margin, but don't worry, you got to make sure this company have some other economy mode. Whether the company has a large market share globally, like TSMC. TSMC is a company which is very capital expensive, or the company has some cost advantage itself. Okay, let's look at the Sheng Siong. Sheng Siong, the capex margin is single digit over time. accept these 2 years as a double digit, it could mean the company maybe is expanding their building base. All in all, is single digit, which is good. But despite this bumpy number, but which is okay because it's a single digit. Lastly, I want to say that free cash flow analysis is not for bank, because in the bank you have a lot of current asset and current liabilities, and then it's very hard for the bank to differentiate operating cash flow and the financing cash flow. So that's why the cash flow analysis is not that meaningful for a bank. Because the changing in the working capital can be very massive. A small change can result in a large change in the cash flow. So my bank don't study their operating cash flow and their free cash flow. So with that, I hope this presentation is helpful for you guys. You have a better understanding about the free cash flow, and then I also if you at best, let's say if you can calculate the free cash flow margin, capex margin, they will tell you a lot of story about the company. Yeah, thank you for watching this video.